What's up everyone, it's Scotty with MoneyVest. So in this video, we are going to be talking about recession probabilities for 2024. We're going to go over a very nice visual from Visual Capitalists, so shout out to them. And I'm also going to talk a little bit about certain indicators that we need to watch with respect to a recession and also the market's timing of a sell-off during a recession, before a recession, and after a recession as well. So we're going to talk about all those different things that are going to be super helpful in timing and kind of understanding. It's not really a indicator that's going to help you to time the market because nobody really can, but it gives you a little bit of an idea on what's happened in the past historically, how the markets have traded in and around that recession timeline. And of course, if we do see a recession in 2024, how to position yourself going into this one. So hope you guys enjoy it, find it helpful. If you do, make sure that you drop a like and don't forget to subscribe to the channel. We'll love to have you on board as a MoneyVest member. You get access to all the members only private videos, our stock reports, our Excel spreadsheets. Everything's going to be included. Tomorrow, Sunday, I will be including 5 new stock reports for all the members to review and analyze, and that's going to be available on our Google Docs. I'm going to publish that over there, and the link's going to be shared in our Discord. So link's going to be down below if you want to join. Of course, be a part of our MoneyVest community, and we'd love to have you on board. So this right here is a 2024 projections. What's next for the U.S. economy, right? Very, very good graphic put together by Visual Capitalist. And they basically mentioned, and this is kind of like, surveys and everything that's been done, that Wall Street expects, in terms of Wall Street, we've got a yield curve at 61% probability that a recession is going to happen in the next 12 months. Economists believe a 48%. In other words, half of the economists expect that the next 12 months, we're going to see a recession. When it comes to Main Street, which is your consumers, 69%. So almost, over a third, 2/3 of consumers believe that the U.S. is going to be in recession by 2024, like in other words, in the next 12 months. And of course, we know the Federal staff is 0% because even if they do believe it, they're not going to admit it because, they obviously need to calm the markets, calm the economy. So 0% of FOMC members. And when it comes to Goldman Sachs, they've put together an assumption or like a probability of 15%. We got Bank of America at 35 to 40%. We got CEOs, highest number here at 84%, right? And this number is actually, I think, come down a little bit, but it is higher, right? C-suite. And these are CEOs of businesses, right? Companies that have a lot of information, a lot of data points. They're working with each other. They're working with suppliers and, they're working with their customers. They have a lot of information, right? And if 84% of CEOs think that the U.S. could be in a recession in the next 12 months, that's a pretty substantial number. Now, this right here is some of the keywords in the earnings calls from these companies, and you'll notice that inflation numbers, or inflation in general, the term inflation has been coming down in the last 4 quarters, 5 quarters. Material costs been coming down. Economic slowdown has also been coming down, and job cuts has been increasing a little bit. And job cuts, usually unemployment is one of the first telltale signs of a potential recession, but we haven't seen that yet. And that's exactly why jobless claims is what I'm really tracking. Very, very important numbers, jobless claims. The JOLTS numbers, of course, and the unemployed persons, JOLTS numbers to unemployed persons ratio. And not to mention the actual unemployment rate as well, because that, is basically going to tell us where the economy is. And right now it's super, super strong. It is very, very tight, the labor market. So there's no signs for a recession anytime soon because we've got a very strong economy, we've got very strong consumer spending, and we've got very strong labor market. Now, the market continues to trade sideways. So if you come over to some of the charts, so S&P 500, for example, right now in a little bit of this downtrend, as we have already discussed. But if you take a look at the weekly chart here, we're kind of in this limbo where we haven't really gone anywhere in over 18 months. So like since June of 2021, the markets are about as flat as it gets. I mean, we have gone up and then had this bear market of 2022 down 26%. Then we rallied a little bit over 30%. Then we have pulled right back down about 6-7%. And right now we're just kind of trading sideways and very, very flat. And from our all-time highs, we are still down about 10.5%. So we're still in a bit of a correction right now. We have obviously recovered from that bear market, but we are very much in a correction. Now, the reason for this video and the reason for this analysis is for us to figure out how the markets have performed during times of recession, okay? Because when there is a recession, there's increase in unemployment, and there's also Federal Reserve cutting rates. So I want to run through this analysis, and I've got several charts that I want to walk you guys through that's going to help us better understand how the markets behave during rate cuts, during unemployment going higher, and also during the uninversion of the yield curve. So all that is going to be discussed in this video. This is what I want to show you guys. And, times have really changed since 1950s, and we're going to go back a lot of years. Like this is literally the S&P 500 over here in the candlestick pattern, and we've got the federal funds rate in orange, which is basically the rate that the Federal Reserve controls. And the point that I want to get across from this video is to help you understand the Federal Reserve, when they started cutting interest rates, all these times, the markets already anticipated that the Federal Reserve is going to cut rates, and they dropped before that even happened. And look, we've talked about in our previous videos, why in the first place? Why would the Federal Reserve cut interest rates in the first place? Right? What would be the incentive? What would be the motivation, right? It would be that they're fighting something, right? They're fighting a recession, they're fighting deflation, something that broke in the economy that they are fighting. And the market in the past has anticipated that very, very well, right? It has done a great job in selling off prior to the Federal Reserve even starting to cut rates. So this right here is again going to be going back as far as 1950s. And what I want you to focus on is the timing of when the markets have sold off versus when the Federal Reserve has started cutting rates. Over here, you can see the market is slightly preceding the interest rate cuts. Over here, you can see the market selling off before the Federal Reserve even starts cutting rates. This right here, once again, you can see the market selling off. And this is a little bit more in line with as the Federal Reserve is cutting rates. But, as we kind of reach towards the bottom for the Federal Reserve, the market's already on its way back up, right? As the Fed is cutting rates, the market has already started to push back higher. Why? Because markets are very much forward-looking, right? Markets already trying to anticipate what's going to happen in the next 6, 12, 18 months. It is very, very forward-looking, right? The market doesn't care about what's already happened. What it cares about is what's going to happen in the future. And you can see over here very well. This right here, the market already is down while the Federal Reserve has reached its top. And then as it starts cutting rates, the markets are already on the way back up. This right here, you can see the markets are selling off. The Federal Reserve is nowhere near close to its low point. And as it approaches its low points, as it continues to cut rate, the market is already on the way back up. Now, that has changed, right? So I'm going to ignore the great inflation of 1970s and 80s because that kind of skews the data all that much. So I wanted to show you 1, 2, 3, 4, 5 examples from the past where the market has been front running the Federal Reserve and it's pushing up as the Federal Reserve's cutting rates because the Federal Reserve's cutting rates to fight recession or inflation or whatever it is. In other words, a recession or deflation, and the market's on the way back up because it's already priced in all that information in. Now, that changed in the last 20 years. And what I mean by that, if you bring the market now, what you'll notice is the market's no longer able or no longer willing to front run the Fed. What we are seeing is the market selling off as the Federal Reserve is cutting interest rates, sometimes so much so that the Federal Reserve has actually been early in cutting interest rates and the market did in selling off. Maybe it's the reluctancy, maybe it's the stubbornness of the market because look, the market, we all make the market, right? Market has its own mind collectively of all investors, Wall Street institutions, hedge funds, sovereign funds, global pension funds, whatever it is, we all make the market. And what you'll notice is that as soon as the Federal Reserve started cutting interest rates in 2000, that actually sparked the beginning of the sell-off in the dot-com bubble. This right here, same exact thing, 07, 08, when the interest rates started getting cut, that's exactly when the market started selling off. Over here, you can see maybe the Federal Reserve was already onto something with cutting interest rates. The markets did not budge, and they only dropped when there was an actual recession, there was an economic downturn, and the Federal Reserve had to cut interest rates back down to lower levels. So I would even argue, looking at this data, that more recently over the last 20 years, the market has become less I don't know what the right word is, but I would say like less intelligent, I guess, or maybe something that is appropriate. In other words, lack of ability to forecast what the Federal Reserve may do considering what's going on in the economy, right? So in other words, the market may be ignoring the reality of the economy, that there is a possibility of a recession, which thereby could result in the Federal Reserve to cut rates. Thereby, we need to sell off today. Instead of right now, what's happening is that we're waiting until that signal actually shows up. And if and when it does, that's when the Federal Reserve is going to cut rates, and that's the possibility for the markets to also roll over. Because, oftentimes, of course, and we've talked about this on the channel, because there's this huge consensus that, as soon as the rate cuts happen, the market's going to rally, right? Market's going to push higher, market's going to do really well, and we're going to see this big bull market as soon as the Federal Reserve starts cutting interest rates. Well, in theory, that may be true, because that is telling us there's more quantitative easing coming in. The Federal Reserve is cutting interest rates to stimulate the economy. But you have to understand why the Federal Reserve is doing that in the first place. Why would they be stimulating the economy in the first place? They're doing that because they're fighting something, which is a recession, a deflation, or any of these other potential problems that they are fighting. And that is inherently going to hurt the economy, which could hurt the earnings, which could hurt the market, and which is what we have seen in the past. In the past, again, and this is prior to 1990s, and even I think in the before 1970s, the market did a really good job in anticipating what the Federal Reserve might end up doing, or it might be very good at anticipating how the economy is doing, really, because the market sold off before the Federal Reserve started cutting rates to support the economy. So the market did a very good job in the past, like I said, to anticipate what's going on in the economy. And right now, I think the market is not doing that great of a job. Maybe it's it's the lack of understanding of what's going on from a more economic standpoint. And look, I'm not saying that there is going to be a recession. I'm not saying that is indeed going to take place and that's going to happen. But of course, if it does, then it's the lack of market's anticipation of that that's going to potentially blindside a lot of investors. Because right now we still look like we are very much in a nice uptrend, and we have already rallied over 30% from our lows from back in October, right? So the S&P 500 has done really, really well so far this year. Now, another chart that I want to go over that I think is going to be very interesting is going to be this one. So what you'll notice is this is unemployment rate with the S&P 500. And once again, what you will interestingly notice is that the market is not anticipating. It's not. I mean, it used to. Again, if you go back, I haven't taken a look at what the 1950s numbers look like, but if we go over to this, I think it makes sense, because a couple times already, so I can already start to see the markets here selling off before the unemployment took off. This is interesting because times have changed, and 1950s, the market sold off before unemployment took off. Market sold off here a little bit before unemployment. So as soon as market hit bottom, this was October 1957, unemployment rate was still at 4%. And then it rallied all this much, and it was as the unemployment rate is going up, the market's going up, right? So in other words, markets sold off 3-4 months before unemployment rate even started pushing higher. So let's just see if we can find maybe a few more examples here. I don't know. We'll see. This one also kind of makes some sense because market's already on the way down over here, and we hit bottom as soon as the market hits, again, 4.5%, and we top out at 6%. So this right here was the entire move. Markets preceding the unemployment rate. This is perfect example right here. Market selling off as unemployment has not even started, and market bottomed at 5.7% unemployment before it took off to 8.9, almost 9%. So this right here. So what I want you guys to understand, and if you fast forward to where we are now, times have once again changed. The market is no longer anticipating what is going to happen in the economy because over here, you'll notice that we didn't quite started selling off in 2000. So we start selling off when unemployment starts pushing higher, right? So in 2000, unemployment starts pushing up and we see the market selling off, right? So it's happening simultaneously. Over here too, we've got, this right here, market selling off as unemployment is pushing higher. So my point that I'm trying to make in this video is that there's a very subtle difference from what happened in 50s, 60s, 70s, and 80s to what happened after 1990s. The market, unfortunately, got worse in predicting an economic downturn. And I'm not saying that that's going to happen. Maybe the reason why the market's not selling off is because it doesn't believe that an economic downturn is going to happen, right? But in the last couple times, we have noticed that the market was blindsided by the economic downturn, 2007, 2008, and 1990s and 2000s. So I don't know. Maybe I'm reading into too much of this right now at the moment. But let me know your thoughts down in the comment section below. Right, in the last couple times it's happened, it's happened simultaneously. As the Federal Reserve is cutting rates to fight the recession, unemployment's going higher, the market starts selling off. But in the past, the market was very good in anticipating an economic downturn, and it was already at its bottom when the Federal Reserve rates were at an all-time high, at a very, very high level, and unemployment was still low. So markets could make that recovery on the way back up as the Federal Reserve started cutting rates and unemployment spiked. So I hope you guys enjoyed this video, found it helpful. Make sure that you drop a like. Let me know your thoughts down in the comment section below. As always, happy investing. I'll see you all in the next video.